Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Alia Sumaiyah binti Zaidi, and I wanted to talk about the Silicon Valley Bank collapse in 2023. FBB is the commercial bank division of First Citizen Bank. Previously, the bank was the main subsidiary of SBB Financial Group, which is a publicly owned bank holding company with operation in more than a dozen foreign jurisdictions and 15 US states. Businesses, individuals, technology, life science, healthcare, private equity, venture capital made up the majority of the bank's clients. Because of its special product and service tailored to venture capitals and startups, SBB stands out as their preferred bank. It provides venture capital investment to about half of all startups. But there was something happened to the bank that leads to the bank collapse. One of the reasons are banks deposit increased, but they have less money on their own to be given out as loan. So the bank was driven to invest the client's deposit in long-term security, mostly bond. Next, inadequate risk management procedure. This has prevented them from recognizing that the Fed was increasing interest rate from less than 1% to 4.75% in less than a year. So the value of the bond they hold becoming more cheaper compared to when the time they buy the bond. Next, too much concentration on bond. SBB has spent the majority of their fund over the past 5 years on purchasing government bond, which equivalent to 108 billion. This has exposed them to the interest rate risk. Furthermore, CEO allegedly spoke sloppily about the bank's liquidity issues brought on by the mismatch between asset and liability. In just 2 hours, depositors withdrew 40 billion as a result of the remark, which contributed to the bank run that ultimately caused the collapse. This is because in the financial market or stock market, everything that happens, even if it is small, can cause a huge problem to the company or businesses. Moreover, concentration of clients which are startup and venture capital. SBB focus more on startup, which makes them vulnerable because startups tend to use a lot of fund or capital to operate their business, which make them always ask for demand deposit. Lastly, interest rate increase. Because of too many funds invested in bond, SBB asset value declines every time the Fed increase the interest rate. Even though the bank asset value has deteriorated, they cannot sell off the bond because they will sell them at a lower price. This could result in a bigger bank losses if the interest rate continue to rise.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nisha Adila binti Hamidan, and I will continue this presentation with my part, which is risk involved. First risk is liquidity risk. Liquidity risk is a risk that arises when the bank is not be able to meet short-term obligation due to insufficient balance. Happen when all the depositors decide to withdraw all their funds simultaneously out of fear of bank insolvency. Next is what is the reason of the downfall of Silicon Valley Bank. First reason is bank itself heavily invest in treasury bond and mortgage during high interest rate. Second, Federal Reserve increased the level of interest rate up to 4.75% to minimize inflation rate and maintain its price stability. Lastly, the reason is the value of bond fall during high interest rate. Next is, what did Silicon Valley Bank do during this problem? First, they decide to sell all their portfolio bond in order to attempt a capital raising. But this action is too late because it resulting 1.8 billion losses due to decline in bond value during the high interest rate. Number 3 is sell another 2.5 billion of share to cover the constant loss. Next is, what happened to the customer? The customer lost their confidence because Silicon Valley Bank eventually triggered a bank run and quickly withdraw all their funds, estimate over 42 billion in a single day. Lastly is what caused the liquidity risk management fail. Number 1 is maybe because of lack of diversification in the Silicon Valley Bank, and second is heavy dependency on long-term security without adequate hedging. Now we move to the next risk, which is interest rate risk. Interest rate is the percentage that a borrower need to pay to the lender for the loan. It is basically a cost of borrowing money that borrower need to pay over a specific period, considered as losses in the investment activity due to fluctuation in interest rate. What caused Silicon Valley Bank exposed to interest rate risk? First, maybe because of mismatched duration between asset and liability in their company. In about 14 billion in cash, 74 billion in loan, 91 billion in government bond. Liabilities in Silicon Valley Bank that are mostly in short-term deposit, meanwhile its assets were locked in long-term fixed rate investment that usually will sharply decrease in value when the interest rate is high. Second, may be because of a new bond in the market were yielding much higher, which is 4 to 5%, that caused the value of older bond to fall. Next is what is lock-in means. It is mean when the government bond and mortgage-backed securities were stuck at low yield, which is 1 or 2%, bank could not liquidate the asset quickly without losing money. Lastly, what did Silicon Valley Bank do? They only imply minimal risk hedging to its bond portfolio instead of full hedging. That's all from me. Thank you.
The third risk is systemic risk. Systemic risk means that when one financial institution fails, instability then can spread throughout the system through things like deposit withdrawal, frozen credit market, and a loss of confidence. It usually comes from two sources, which is the first one is balance sheet, contingent, and information leaks. SVB is a clear example to show how this risk works. The bank sold $21 billion in security at a loss of $1.8 billion, which triggered panic. Since 94% of its deposits were uninsured, worth about $125 billion, this tends to make depositors rush to withdraw. On March 9, $40 billion was withdrawn and the bank expected another $100 billion on the next day. However, because of the sufficient cash, on March 10, regulator had to step in and close the bank and turn it over to the FDIC. This collapse quickly spread via the other banks, with investors selling bank stock globally. Information leaks exacerbate the panic, as people assume other banks might be facing the same risk. This shows exactly how local problems can turn into systemic risk. The last risk is market risk. Market risk, also known as a systematic risk, refer to the potential for losses caused by changes in financial market, such as interest rate or exchange rate. This kind of risk affect the entire market at the same time. SVB faced a major problem because of a mismatch between its liability and asset. Most of its capital came from short-term deposit, while much of the money was invested in long-term mortgage-backed securities. When the Federal Reserve raised interest rate to fight inflation, the value of these long-term securities fell sharply. As losses grew, depositors panicked and started withdrawing their money, leading to a severe liquidity crisis. On top of this, the bank risk management was very weak. The board of directors did not hold management accountable. The bank ignored its own stress test, and it even stopped hedging against interest rate risk. Instead of addressing the problem, the bank changed its assumption to make the risk look smaller. As a result, SVB could not handle the massive withdrawal request, even though it was technically solvent on paper. This case shows how market risk combined with poor management can lead to a bank's collapse and shake the wider financial system.
Moving on to the lessons learned from the collapse of Silicon Valley Bank, one of the key lessons is the importance of diversification. SVB invested heavily in long-term US government bonds, which has lost value when interest rate increased in 2022 to 2023. This has left the bank struggling with liquidity and unable to meet withdrawals without major losses. At the same time, SVB relied too much on tech startups as clients, a sector highly sensitive to funding cycles. A more diversified approach, which is spreading investments across short-term securities, liquid assets, and varied customer base, could have reduced this risk. The key takeaway is clear that diversification can build resilience and help financial institutions adapt to sudden market changes. Next, the collapse of Silicon Valley Bank shows why managing interest rate and market risk is critical. SVB invested too heavily in long-term government bonds. When the Federal Reserve increased rates, those bonds lost value, creating huge losses when the bank had to sell them to meet withdrawals. Effective risk management means stress testing portfolios using tools like interest rate swaps or futures to hedge risk and balancing profitability with stability. SVB also failed in communication, which its sudden announcement caused panic and a bank run. The key lesson is clear that banks must be proactive, diversify strategies, and use strong risk governance to withstand market shocks. Furthermore, the collapse of Silicon Valley Bank was due to poor liquidity management. When startups began withdrawing large sums, SVB lacked enough cash or liquid assets to meet demand without heavy losses. Its reliance on long-term bonds made the situation worse. Adequate liquidity buffers, as required under Basel III, are essential, but SBB showed that meeting only minimum standards is not enough. Banks must hold higher liquid reserves based on their client base, run stress tests, and prepare emergency funding strategies. It is clear that liquidity is not just about profit optimization, it builds depositors' confidence, prevents panic, and ensures long-term stability. Last but not least, lesson learned from the collapse of Silicon Valley Bank is the importance of customer trust and effective crisis communication. Even a stable bank can fail if depositors lose confidence and rush to withdraw funds. SVB's sudden announcement of bond losses and emergency capital needs created panic instead of calming fears. Trust must be built over time through transparency, good governance, and clear messaging. In a crisis, banks need proactive communication by explaining risk, reassuring depositors, and engaging regulators early. It is clear that financial stability depends not only on assets but also on psychology. Strong trust and clear communication could prevent panic and protect banks during their instability.
My name is Anezazuryn, and as the last presenter, I will be presenting on the recommendations. In this part, I will go through 4 key risks that we have identified and share our recommendation related to each of the issue. Let's start with the first risk, which is liquidity risk. The main issue here is that SVB failed to maintain a sufficient cash reserve and liquid asset, and they also show a poor liquidity management lead to panic withdrawals. To address this issue, we recommend that financial companies to maintain a minimum cash reserve and have a sufficient liquid asset by planning the financial holding effectively to stand emergency situation like stock market decline or economic activity decline. Next, they have to conduct a consistent risk monitoring their operation by using the stress testing method and scenario analysis to measure resilience. With this action, they can ensure effective liquidity management to build trust with the depositors. Moving on to the second risk, which is interest rate risk. The issue of raising interest rate will reduce the value of SVB long-term bond portfolio. Technically, it will impact the cash flow, profit margin, asset, liability, and it will also lead to economic uncertainty. To overcome this issue, we propose the recommendations of balancing the long-term and short-term asset to maintain adequate liquidity. Next, companies that emphasize consistent interest rate risk management in financial strategies by applying the hedging mechanism is one of the best action to reduce the volatility. They can also monitor central bank policies to anticipate the interest rate changes. Now let's take a look at the third risk, which is the systematic risk. The main issue here is that the external market factors such as global financial crisis, inflation, rising rates cannot be avoided. And the other issue is financial companies cannot depend on only one sector, like what Silicon Valley Bank did when they rely heavily as much as 50% on one sector, which is technology companies and startups. So, how can this issue be managed? Our recommendation is to avoid high dependency on only one industry by applying the diversification strategies in investment portfolio and customer groups, as well as expand the customer base to SME, traditional industries, and individuals. This action will strengthen the resilience by ensuring consistent income flow across multiple sectors. As for the financial risk analyzed is market risk. The issue that has been found is the uncontrollable external factors like economic recession, political tension, global instability will cause losses to the financial companies and economy, as what happened to the Silicon Valley Bank when they experienced the bank run. As for the additional information, market risk involve equity risk, interest rate risk, exchange risk, and commodity risk. Therefore, the step that can be taken is to strengthen a straightforward and impactful risk management to gain high trust from the investor and customer. This is one of the productive process to maintain a strong trust to prevent panic withdrawals in future crises.